This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, what Walmart just did is beyond belief, because this comes at a time when we hear about the strength and the robustness of the labor market from policymakers who say that we're going to be trapped in a wage price spiral where wages are going to lead to higher inflation. And then that's validated by the fact that many unions right now are negotiating large pay increases for their members, making, of course, the claims from the Fed seem very real here. Yet what we just saw Walmart do is actually beyond belief, because it says perhaps that for a moment that the labor market and the U.S. economy may not be anywhere as strong as experts believe. And of course, if you're wondering what we're doing in China today, well, we're at the People's Bank of China because we just got word that they've been buying something en masse that doesn't make any sense. In fact, we're going to make the case that Beijing is making all the wrong moves and at the wrong time. And of course, all of this comes right back to our headline story of Walmart. Of course, we know what goes on in China has a direct impact with America's largest retailer. Let's over to Bloomberg, where we picked today's story up with a headline: the yuan drops toward record low as China budges in fight with the bears. Now, we've been talking about how, of course, the Chinese yuan is dropping in value, and Beijing is doing many things, not everything, but doing a lot of things to keep it from falling. And of course, this is interesting because as we talk about what's going to happen with Walmart later in today's show, you start to think about the bigger picture here. Is a weakening yuan against the dollar should actually lead to a larger amount of exports coming out of China. Of course, what are we actually seeing? Well, quite just the opposite. And China's currency declined as low as 7.3623 per dollar in overseas trading. This is close to one of the weakest since the creation of the offshore yuan market back in 2010. The move came after the People's Bank of China says so-called fixing rate at a 2-month low on Friday. Now, what's interesting here is you see MAN, or essentially central bankers, attempt to manipulate and control the currency, which we've made the case of. These central bankers think they have control of currency, when in reality they don't, because if what the People's Bank of China was doing worked, they wouldn't have to keep doing it. They would set their fixing rate and, well, it would stay there. But they're missing the big picture. Is demand for currency has so much to do with global trade that they just can't see what the real problem is. The PBOC is faced with a daunting task of maintaining the so-called impossible trinity, where it needs to stabilize the exchange rate and prevent capital outflows while keeping an independent monetary policy. So if you think about why they need to maintain what we call a stable currency, because when people are using a currency for trade, they don't want to see large fluctuations in it. And we know that China's been making some moves over the past couple of years to get more of its trading partners to use the yuan. Well, if it keeps going down in value after they get it, well, it's really not a big incentive for them to trade in it. At the same time, we've been making the case lately that people inside China facing a weaker currency, well, they want out. And sure enough, they do. And of course, if we look at the outside picture coming in, many people say that this has to do with divergent monetary policies between the Fed and the PBOC. Well, that part I'm not so sure about. But China's sluggish economy and dovish policy are heaping pressure on the yuan, especially as resilient U.S. data and a high interest rate differential there has traders favoring the dollar. Now, from that standpoint, we could make the case. There's higher interest rates in the U.S. The currency here is not falling on its face. So yes, maybe there's some argument for that. But what the real key here is external demand from exports coming out of China are decreasing. And of course, if trade is decreasing, in turn, demand for currency actually goes down. And such a trilemma is not new to Beijing, having occurred in the aftermath of the shock yuan devaluation in 2015 and during the height of the nation's trade war with the U.S. 5 years ago. giving us kind of the question is, why are things different now than they were in 2015? Past experience shows policymakers tend to prioritize growth and allow a controlled depreciation eventually, as a weak yuan makes China's exports more competitive. And here it is. It comes right back to global trade, because what was the narrative, coming into the slowdown here in the global economy was the Chinese consumer had a bunch of money. They've been locked down. The doors are going to open and they're going to come out and spend like crazy, just like U.S. consumers did during the pandemic. Of course, what did we see? Well, not quite that effect, because as Chinese consumers came out from lockdown, they turned and looked around and said, wait a minute, the entire global economy is slowing. And as the world's largest exporter, whose jobs are very much a part of that dynamic and controlled by that, well, they said, wait a minute, if this is getting worse, we're not going to go out and spend here. And all of a sudden now, what you see is this all comes back to global trade and global demand. And that's why the yuan is falling. And that's why Beijing can't stop it. And here we can see, looking at, of course, Treasury yields, we can go back to 2015. And I want you to see that after the devaluation, something really interesting happened is yields on the 10-year Treasury, and of course, across the yield curve went down. And this makes sense, of course, because what would happen following that is eventually China would start buying more U.S. Treasury securities. And because global trade started to pick up, and this was a good thing overall for the world, because as the yuan goes down again, it makes China's exports far more competitive on the global landscape. And that means U.S. consumers, from wherever they're shopping before, tend to have a bias now toward buying out of China. And then the global engine of dollars starts to restart, and we see circulation of currency going around the world. And next thing you know, everything starts to work. And that was, of course, we can see going back, had a lot to do with that devaluation of the yuan back then. But let's continue on here, because what we could see in the nominal broad U.S. dollar index and following 2015 and 2016 is that it increased as well in value, which would make perfect sense, because when you start to think about what actually happened here is the yuan was devalued, and that sent the dollar higher, making dollar exports coming out of the U.S. less competitive against the rest of the world, again turning U.S. consumers onto China. And sentiment is also affected by the lack of real improvement in the economy and corporate profits. Until then, the yuan will likely face depreciation headwinds, mainly because you're looking at a case where people just don't want it. There isn't demand for yuan, despite, of course, Beijing's attempts to get other people to trade in it. Of course, the rebound in the dollar is not just causing trouble for China. In India, the rupee is also close to its weakest on record, and Japan this week escalated its verbal warnings against yen bears, with the currency back at more than a 3-decade low. So what's interesting here is everyone really doesn't want the dollar to go higher, yet we're going to make the case the dollar is actually probably going a whole bunch higher before it goes down. And here it comes back to this imports of goods. So we look here in 2015, we see the devaluation, and what happens? Imports start going up. So we go look backwards coming into 2015, we see imports coming down, China's forced to devalue, and next thing you know, imports are rising. Now, the reason I showed you earlier that chart about 10-year Treasury yields, well, it matters quite a bit. But look at what's happening now. We see imports of goods and services into the U.S. declining, which would suggest, indeed, of what we know is that there needs to be a stronger dollar to encourage that. Now, the problem is it's not working. We're seeing the dollar go up in value, but we're not seeing a big increase in imports. We notably can come back to the pandemic and say, wait a minute, a lot of this recently had to do with all the stimulus, and that, as far as we now know, if it's not gone, it's almost entirely gone. And Beijing has announced a slew of other policy measures to help boost the economy, many targeted at the faltering property sector, as it tries to stoke internal demand. And yet China's support measures are gradually coming through. Investors are not likely to see a rapid rebound in the currency, because in order for the currency to rebound, and this is a key point I'm trying to make here, is we need to see the global trade start to increase. And that's what all comes back to Walmart and how this all gets tied together, because it's not just things that happen on a local level or a regional level. We're in a global economy. And that's what makes this very interesting, because I want you to see next, again, why we're at the PBOC today is because they're going on a buying spree of the wrong thing. But many gold bulls will love to see this headline as China's gold binge extends to the 10th straight month as reserves climb. Now they're talking about, of course, gold reserves here, but what's interesting to me, and I want to put this kind of as a reminder now as we go into the next couple slides here, is that China has been draining its currency reserves, its foreign currency reserves. You may recall in a recent show, we talked about how they stopped reporting about their foreign currency reserves, suggesting they may be a lot lower than most people think. And here you can see that China added to its gold reserves for a 10th straight month, extending a push to bolster its hefty stockpile as it tries to diversify away from the US dollar. And there it is, the news trying to tell us what's actually going on here. I don't think that's the case, that they're trying to diversify against the dollar. I think they're trying to buy gold to say, look, our currency, our yuan, has gold back here. It's not a gold-backed currency. Let's be clear about that. But I think they're trying to say is, look, our currency doesn't have to fall in value. We've got plenty of good reserves. But bullion head value of the People's Bank of China rose by 930,000 troy ounces in August. That's equivalent to about 29 tons. And here we can see Asia's biggest economy among the most enthusiastic buyers of gold in recent times as it focuses on ways to diversify its monetary reserves. Again, which is notable because they're losing their foreign currency reserves as global trade shrinks. The massive purchases has helped underpin prices despite rising interest rates around the world, which typically saps demand for non-interest-bearing bullion. And so here's the idea is, for some reason, they're trying to prop up the gold market, which of course, to me, makes absolutely no sense. I think this has to do more with the yuan. And of course, as we kind of tie everything together with Walmart and what they did, just doesn't make any sense. If the global economy is booming, then what Walmart did, they shouldn't have done at all. But what it tells us, and what we're seeing out of China, this decline in exports out of China, the slowdown in imports into the U.S., it all matters. It's telling us exactly what I've been saying for a while, is that the slowdown is coming to the U.S. But one thing that appears to be going down is gold, despite the fact that China is buying. Let's take a look at how our CTA-Timer Pro, again, we have a report that looks at how the machines trade the market and then runs a historical overlay. Let's look at gold here because we can see the first really selling indicator came back here a few months ago, and sure enough, gold prices went down. We got one here recently, and gold prices went down, and now we're starting to get one again. Of course, we'll cover this in more detail on the Sunday show, but check this out. Here we can see going back into May, on May 17th, we see it start to indicate the machine positioning that they were selling down. We look again here on August 9th, we see that happening yet again, and then for a third time here we have it again around September 8th. We see the machines starting to sell. So all this comes back to is you notice that central bankers try to do a whole lot of things. They try to prop up their currency, they buy gold, and yet it seems to have really no effect on the broad market. Well, you can actually find out how the machines are positioned too and use it to trade to your advantage. There's a link in the description below. It's $30 a month. It comes with a 14-day money-back guarantee if you don't like it. So try it out and you'll see why so many other people say this report has totally changed how they trade. And despite that, Beijing, who should probably buy the report instead of buying gold, their appetite for bullion remains persistent. The country's appetite for gold has been linked with a broader global move to reduce reliance on the U.S. dollar, as President Xi Jinping has strengthened ties with the BRICS nation counterparts as the bloc strives to conduct, here we go, and this is the case I've been making right here, conduct more trade between themselves and their own currency, because what would disaster cause if their currency started to go down in value? But who would want to trade in the yuan? And that's the point. I think Beijing's not worried about the dollar here. They're worried about their their own currency, because if it continues to go down in value, their own people don't want it. And if their own people aren't wanting it and it continues to fall in value, who's going to want to trade in it? And so that's why they're really buying gold here, is to try to prop up their currency. But what they should be buying is U.S. Treasuries. And I know many of you are probably shaking your head right now and getting ready to make some comments, but check this out. In a gold-based system, do you know what you want to accumulate? Gold. In a dollar-based system, you want to accumulate dollars, and you do that in the form of U.S. Treasury securities. And I want you to see here that if indeed China wants to revive their economy and the global economy, well, the answer is they're buying the wrong thing. And that's what we see Walmart making perhaps the first move to indicate that perhaps things in the world aren't as good as policymakers say. And here you can see, as we look at Treasury securities held by foreign official institutions, now we'll go back to 2015 and we can see that they're losing them. They're selling them off. Why? Because they need dollars. They're trying to raise dollars. That's why they sell reserves. That's the whole point. Think of it as your savings account. When you need money that you don't have in your checking account, if you're short, you draw it out of your savings. That's the same effect here. But look what happens. In 2015, they devalue the yuan. They're still notice the global economy is slowing. There's still need for dollars. And all of a sudden that turns up and everything around the world is okay. Look what's happening now. We see a global dollar shortage. And again, rather than letting their currency continue to fall or perhaps even devaluing it further, which I think would make a lot of sense, they're trying to fight the trend. Now the problem, remember I said we talk about this 10-year Treasury yield issue, because what happened last time is they did this, they devalued, and then they started buying Treasury securities to drop interest rates down. And what did that do for American consumers when they saw that things out of China were cheaper and the cost to borrow money to buy those things was cheaper? Well, guess what happened? They started buying, and the machine of the global economy, we start to see the gears start to move, dollars start to circulate, and everything changes. But so right now, in my opinion, China shouldn't be buying gold. They should worry about the value of the yuan. Should be buying treasuries, because at the rate things are going, what we're going to see is the global economy slow down far more and watch the yuan continue to plummet. And here we can see that U.S. retail workers are now fed up as we get into talking about what's going on with Walmart, and are quitting at record rates. But maybe they're not quitting as fast as this article has us to believe, because when you see what Walmart did, well, again, it's beyond belief. In 2022, McKinsey study found the quit rate for retail workers is more than 70% higher than in other U.S. industries, which is a shock, because I once, a long time ago, worked in retail, and I'm sure many of you have as well. There often isn't a day that you don't want to quit, because it's just the nature of the job. It's not an easy job. It's very challenging, and the pay just isn't that much. And the COVID years made the problem worse. Before 2020, turnover for part-time retail, who make up the bulk of in-store work, hovered around 75%, according to the Corn Ferry. And since it shot up 95% and hasn't budged, which has led times to understaffed stores, as many of us have seen over the recent years. And retail wages are rising slightly faster than those in other industries, but retail employees still get paid a lot less than the median U.S. worker, which kind of gives us an indication. What Walmart just did is telling us that maybe things in the economy are far slower. Check this out. From 2006 to 2022, the median wage for retail salespeople rose 55%, while U.S. workers saw a 52% overall gain. Since 2019, retail wages are up 21%, compared with a 16% gain overall. But now we turn to Walmart, and here you can see they've cut their starting pay for some new hires under revamped wage structure. Now, if the economy was booming here, which is what we continue to hear, and everything was great, what we should see is that Walmart should be raising wages for everybody. Now, remember, I've mentioned this is likely going to happen, that in periods of high inflation, what we see is employers are forced to give their employers higher wages, who then believe they're going to continue to get them. But as inflation cools, as demand slows, well, the employers don't have the margin to give them higher wages. So eventually, as the economy slows, they turn to layoffs. Well, the first move now we see from Walmart is saying, look, there's plenty of labor demand, and we're going to prove it, because we're not going to give these new hires the big wages as we're giving everyone else. And here we can see some validation in that everyone's worried about a wage price spiral, including the Fed. Well, here you can see average hourly earnings of production and non-supervisory employees against the consumer price index shown in red. And we can see where the consumer price index goes, that wages tend to follow, which makes perfect sense because businesses do not have some magic fairy pot of money that they can just tap into to give their employees wage increases. If prices aren't increasing, then wages aren't increasing either. And here you can see eventually what happens when you have periods of high inflation. It leads to layoffs, as I've made the claim. You can see going back into the 1970s, we saw something different, that higher inflation led to higher unemployment claims, as shown by, of course, the 4-week moving average of initial claims in blue. But that would later change, where we now see the peak inflation rollover of inflation leads to higher unemployment claims. Now, the Fed's looking back here in the 1970s and 80s saying, look, this is the model. What we're suggesting now is as you see inflation peak and roll over, that's when initial claims skyrocket. We're seeing that effect now, suggesting that as demand goes down, well, then that means we don't need as many workers. And as you're about to see, Walmart has already figured that out. The lower rates will affect new employees such as online order pickers and shelf stockers, according to Walmart. Those employees would previously have earned more than newly hired cashiers, as the new wage structure also led to a pay raise for about 50,000 existing employees were making less than the new minimums. And we can see with the overhaul, the country's largest private sector employer is aiming to improve customer service by making it easier for workers to move from one department to another. So here we can see if labor demand was so strong and there was a shortage of workers, which I'm going to make the cases during periods of high inflation that doesn't happen, Walmart would be under pressure to give these new hires a much more competitive wage against its other workers, suggesting to us that perhaps what we're seeing in China, the weaker yuan, the slower trade data is filtering its way into America, and Walmart is seeing that because check this out, as you're about to see, the labor force participation rate, this shown in blue, against the consumer price index. Now, the labor force participation rate is the percentage of age-eligible workers who are in the workforce either working or looking for a job, and lo and behold, you will not be surprised to see this. As inflation rises, people go back into the workforce because they can't afford it. You see that here going into the global financial crisis. You see that in the dot-com bubble. You see that now as inflation took off. We see more people entering the workforce at a time when we continue to hear there's a labor shortage. Well, according to Walmart's latest move, perhaps the opposite is now starting to happen, and that's why this is beyond belief, because all these policymakers and experts have been saying that the U.S. economy is going to avoid a recession due to the strong labor market. Well, maybe based on what we just saw from Walmart, the labor market's nowhere as strong as they think. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.